In this video, you will understand more why the economic headwinds that Kavana and CarMax are both facing are getting stronger. As of 2020 and 2021, these two stocks have performed the S&P 500. This year, CarMax is down 44% and Kavana is down a whooping 96%. So according to the Financial Times, rising used car prices helped drive the worst US inflation in a generation. Government statistics show prices are 49% higher than in June 2020, early in the coronavirus pandemic. While prices are still high for historic standards, the gains are sharply decelerating. In October of this year, 2022, they rose 2% year on year. The US Bureau of Labor Statistics reported last week, down from an annual rate of more than 40% in early 2022. At the online marketplace cars.com, the median price for used vehicle in October decreased more than 3% from a year earlier on to $23,499. The decrease has ramifications for manufacturers, dealers, lenders, shoppers, and potentially the wider economy as inflation shows signs of cooling off. The price rise of the past 2 years was fueled by a scarcity of new cars and trucks, as worldwide shortage of semiconductor chips limited the number of vehicles that car makers could produce. The smaller supply of new vehicles forced more consumers to turn to the used market, including rental car companies hungry to replenish fleets. They had shrunk during the shutdowns of the pandemic. Now, an increased supply of new cars and trucks, plus rising interest rates as the Federal Reserve fights inflation, are causing demand for used cars to ebb. Dealers are cutting prices to keep car payments attractive to shoppers as higher borrowing costs make financing less affordable. The Federal Reserve made a decision to raise rates, and for better or worse, it's doing its job, according to Behrman. Behrman is probably the vice president of Behrman Auto Group. It's basically slowing consumer demand. The same vehicle at the same price today is going to cost the consumer a lot more. That by default lowers demand on those cars. The declining prices of used cars are felt by family-owned dealers and large chains alike. So the S&P Global recently changed its outlook on Kavana to negative because of weakening profit margins, cash flows, and liquidity. More than half the dealer's gross profit per unit comes from selling loans and other products, but Kavana is poised to lose a share of this business. With rising interest rates, it is more difficult for Kavana to compete with large banks that can keep loan rates low, according to S&P analyst David Bean and Nishit Madlani. The company would need to seek fresh capital to maintain its liquidity in 2024, they added. Falling used vehicle prices traditionally had been the canary in the coal mine for new cars and trucks, according to Steve Brown, an analyst at Fitch Ratings. They signaled a declining demand for new vehicles, forcing price costs and, in turn, lower production by manufacturers. That pattern may not hold. US car makers made on average about 11.2 million vehicles a year for the 5 years preceding the pandemic, according to Christine Dizikchek, an automotive policy advisor at the Federal Reserve Bank of Chicago. But the chip shortage and curtailed production, they made just below 9 million cars a year in 2020 and 2021, and a forecast to produce less than 10 million this year, 2022. Because manufacturers have built fewer new vehicles in the past 2 years than consumers want to buy, falling used vehicle prices may not translate into lower prices for new cars and trucks. Car makers have also spent the past 2 years allocating scarce chips to the most expensive versions of their most profitable vehicles, essentially abandoning the low end of the market. Okay, so that's what's going on, and you definitely must have seen CVNA stock in the news over the last few days. The stock has been in the news at various times, trading heavy volumes. Short interest, as I indicated earlier on, is around 43.76% and increased by 9% of late. Okay, so moving on, we can see what we are talking about here. In the last trading session, the session of the 18th of November, CVNA lost 3.13%, 22.3 million shares crossed the tape. And you can see that 96% decline we are talking about here. It started to, decline, and there was only one occasion, about a few occasions when it crossed its 50-day moving average, sometime briefly sometime in March, and then it did again in July, and it stayed above that, maybe because of the summer. Things looked good, even actually getting support from that 50-day moving average, and pivoting from there, and rose above its 20-day moving average. You probably thought things have now improved. It got a support from its 50-day moving average. No, it's not going to decline. That's remarkable. Got a support. It bounced. It pivoted, but no, it declined. It's from that time when it declined on the 16th of September, it has remained below below those two moving averages, the 50 and the 20-day moving averages. And then for this week, I think it is down 34.64%. And about 11 days ago, we covered CVNA, and we indicated that the probability of the price to remain below 41.77% probably over the next 50 trading sessions, I believe, is let's see whether that is the case. Over the next I believe that's the case. Yes, 20. Okay, let's see that moving average on the 11th, on the 9th of on the 7th of November. That was when we covered this. 7th of November. Let's see. 7th of November. Yes. So let's find out what the moving average was on that day. Okay. Well, in any case, the probability that you remain below 41.77%, $41.77 is I think over the next 50 trading over the let's see it over the next 200 days. I think over the next 50 trading sessions is probability that you remain there is around $98.12. So there's a good chance that this decline we are looking at right now will continue to prevail. Probability of it remaining below 26.54. 26.54 is let's get where that is. 26.54 is somewhere here. 26.54 is around somewhere here. 26.54 somewhere here. So probability that will remain there is 63.31. So there's every chance things are still going to remain negative for CVNA stock. But like I indicated earlier on, deep buyers are hoping for a short squeeze, and maybe that will help them. If that happens, CVNA might raise the needed liquidity, needed capital for the coming years. But it may not need that money now, but who knows? It may. If any rally occurs, expect. That's our guess. Expect a fundraise to occur. So short interest 43.76%. Let's see whether we can do some upward projections using plotting a Fibonacci grid here. Pick it up from here. 55.77 all the way down to the way down to 1.13 dollars. So upper projection 13.95, 22.04, 28.79. None of these, there's no guarantee any of these will happen, but given the short interest that is there, you never know what's going to happen. So see what you make of CVNA stock, and indeed the broader market, the broader car dealer market, or rather the broader car dealer market. Okay, so thank you very much for watching this video.